Hi everybody, today I'm going to share with you the Asia's largest logistic REITs, which is called Mapletree Logistics Trust, which is listed in SGX since 2005. So over the past 15 to 16 years, these REITs have grown to become one of the largest REITs in Singapore. When we talk about logistics, logistic trust, actually we indirectly meaning warehouse properties. And when it comes to warehouse property, actually indirectly warehouse it also means e-commerce business. Especially during this pandemic period, e-commerce actually we can see a lot of e-commerce stock has started to boom all this. So actually it have further propelled logistics trust to perform better. And let's look at how many property like Mapletree Logistics Trust have. They have more than 160 properties across 9 areas, over 50 over cities, and they are Asia focused. So you can look at it. Their countries from Singapore, Hong Kong, China, Japan, South Korea, Australia, Malaysia, Vietnam, and India. And when I talk about risk investment, we always look at number of properties they have. Why we want to look at number of properties they have is the more the property a REITs have, the more diversification they will have. So this will able to cushion the risk from any things that happen to the REITs. For example, it actually happened that, for example, one of the property in Mapletree Logistics Trust actually catch fire and burned down. But it didn't really affect the REITs because they got 100 over properties and they got time to rebuild the properties. So this is why when we look at REITs, we will want to focus one key thing is called the number of property they have. And especially on industrial REITs or logistics REITs, we expect them to able to get a lot of properties because the property value is definitely much lesser compared to buying a shopping mall, buying a office building. And we also want to look at a REIT that is diverse over different countries. So they were able to prevent political risk in certain aspect. And you can see that Mapletree Logistics Trust actually is very well diversified REITs. You got 100 over properties and diversified over multiple countries and cities in the Asia region. Let's look at what is the contribution on various countries and cities. Singapore is on the asset. Singapore is still the key contributor. We contribute about 24% in the asset, and the revenue contribute about 29.4%. Followed by Hong Kong and China. And they have started to enter into a new area or new country, which is the Indian market. Few months ago, and I feel that the Indian market the weightage should expand over time, and thus it will be less reliable on Singapore, which is also in a good news. We'll talk about that later. And let's look at the key financial indicator. So Mapletree have asset more than 10 billions. And their gearing ratio is currently still very on a healthy level, about 38.2. And for the past track record, we have seen that the REITs will try to maintain their gearing ratio below 40. Below 40. But I think with the gearing increase, MS have increased the gearing cap from 45 to 50 since last year. I think the REITs may want to push it higher going forward, but it may be this in that case may be also good news as they may able to buy more property before they call for any equity fundraising activities. And the interest cover ratio is 5.2. It is a very healthy reading, especially during this pandemic, where we can see that some of the REITs can't even meet the MS requirement of 2.5 at this current pandemic period, and for them they are 5.2 is way above the requirement set by MAS. And when I look at property, I also want to look at occupancy. You got property but can't rent out, also no use. And for them, year on year, quarter on quarter, the occupancy rate is constantly staying on the very high side and above 95% constantly. Even across any region or country. And we also want to focus on concentration risk by one tenant. we don't want a tenant to be a big contributor to the risk. Okay, as any financial situation were to happen to that tenant, okay, it will have a negative impact to the risk. Okay, so we can see that the top 10 tenant, the top main tenant is CWT. It contributes about 7.2% of the risk gross revenue. But one thing I noticed over the year is the weightage for CWT have to the risk, okay, have started to drop along the year, okay, which is a good thing. Okay, when I look at it, as it's trying to reduce the risk exposure of the risk to just one company by itself. And the top 10 customer account actually contribute only about 1/4 to the gross revenue. So the impact to the risk, okay, will be minimum if any of the top 10 tenants were to suffer any difficulties along the way. Okay, and this REIT have more than 700 customers. Okay, and across different industry, and approximately 3/4 is serving consumer related sector. And so this risk itself is more towards very well diversified and with a very big tenant base, which I also personally like that. This is one thing that we need to take note when investing in REITs. Okay, if the REITs are not buying freehold property, there's always a lease will expire. So this is why when a REIT start to go overseas, which sometimes is also good news, is in Singapore context, you hardly find a freehold properties, especially on the industrial building aspect. Okay, and thus, if the REIT is still focused on Singapore, then we may want to be concerned about what happen one day if the lease were to expire. Okay, so this is something we need to think on that. And you look at the lease expiry date. Okay, so currently the weighted average lease is 44.1 year. Okay, which is pretty decent. I just want to draw your attention to this one. Okay, where they got 5.3% of their net lettable area is have a lease of less than 20 years. Okay, and all these property are actually in Singapore. Okay, all these property are in Singapore. As we know that Singapore industrial building, the basic tenure is 30 years, okay, or 30 plus 30 or 60 years, but they got about 5% of the net lettable area that are going to expire very soon. Okay, within the next 0 to 20 years. Actually, I think there's one property you need left about 5-6 years to go. Okay, so but because of their base, with their big base, 100 over properties, so the impact of all these property lease going to expire to the REITs, the impact will be very minimum. Okay, so thus when it comes to investing in REITs, so this is something you need to think note of that. Okay, so size and quantity of REITs actually really matters a lot. Okay, when it comes to this type of situation. And look at the performance. Mapletree Logistics Trust has performed very well since the IPO till today. If you have invested in Mapletree Logistics Trust at their IPO, that's on 28th of July 2005, okay, and you hold until 31st of March, the total return you get is 345%. Okay, the dividend you collected is 161.3%. So what does that mean? It means that if you put in $1 inside, the dividend you collected is $1.60. Okay, so what does that mean? That means that practically you get back all your money and you even gain from the dividend. And the capital appreciation is 183%. So whatever money, whatever share price you see, whatever market value you see is all pure profits. Okay, and it has also outperformed the STI index by a very big margin. When I look at this chart, STI only up 38.8%, while the REITs up 183.8%. Okay, it is a few times. The performance is really big STI by a very big gap, and it also performed better than the FTSE FST, the REITs index. Okay, so this is the performance of these REITs since IPO to 31st of March. Okay, and we look at performance during the COVID period. Okay, that's from 1st April 2020 to 31st of March. That's after the COVID, after the market come down. Did they actually recover? Actually, they went up 20%. Okay, they slightly lesser than the STI. Okay, by about 5%, but it's better than the REIT index. So in general, Mapletree Logistics Trust, okay, is a very resilient REIT, okay, that have a very fantastic track record that performed so well over the years since IPO until today. Okay, and let's look at their dividends. Okay, and when we want to look at REITs, we also want to look at a dividend increasing REITs. Okay, the focus is more towards the DPU, okay, more towards the DPU rather than the distributor income. Okay, because a distributor income increase doesn't mean your DPU increase. Okay, so this is something to take note. So we should focus more towards the DPU rather than the distributor income. Of course, we want both to increase along the way. Okay, so you can see how the DPU have performed. They have reached a peak before the GFC global financial crisis. That after that they have dropped. Okay, because due to the market downturn, they are actually being affected also. But did they manage to recover? Actually, they have managed to recover. And back in 1314, actually their DPU have become higher than before the GFC. And after that, it never stopped them, their DPU to keep on increasing. And even during this pandemic period, actually their DPU even go even higher. Okay, so this is the track record of these REITs. Okay, and let's look at the chart. This is a price chart of these REITs since IPO to today. They are hit badly by during the global financial crisis where it plunged out to about 30 cents. But did they actually recover? As you go and look at some of the REITs, their share price, or not even some of the REITs, some of the stocks, their share price may not even cross their peak of 2008 global financial crisis price, even up to today. But for them, they actually went higher and created a new history high price. Let's look at the performance of these REITs during the COVID-19 period. The REIT share price actually have dropped to 120, which is about the same as their NAV price at that point of time. Okay, when you look at a REITs, right, I always look at the price to NAV, and I personally would prefer a REIT's price to NAV is above 1. Okay, especially during the worst case situation. Okay, where it happened to be in March 2020, and because as this will tell you that the fundamental and there's a very strong support on this REIT. Okay, and after that, the REITs actually recover very fast. By August 2020, actually it hit a history high price of $2.21. Okay, as they have actually indirectly benefit from the pandemic because they are doing warehouse, indirectly related to e-commerce, and we know that there's an e-commerce boom when there's a global lockdown during this period. Okay, after that you can see that the share price has started to weaken, okay, by a fair bit, because they went for a swapping spree to acquire a lot of properties in the region, and they also have done some equity fundraising. This caused some drop in the share price, and after this dust is settled, we can see that the share price has started to creep up progressively over time, and at current price is about $2.11. Okay, to me that this REIT will have a good growth potential going forward. First is they have a lot of properties, like 160 over properties across the region, and it's very well diversified, and it's very well managed over the year. We can look at the track record. They've delivered the return they have delivered to the unit holders along the way, and they are in the place that is on a have a very huge growing prospect, which is the e-commerce prospect. That's all I have to share today. And if you feel that you have benefit from this video, do like and share this video, and I shall see you in the next video. Bye bye.